All right, this time we're going to be talking about your spending and your tax multiplier. This will very likely be seen on your part 2 question on the exam. And this relates back to how the government can try and alter aggregate demand, right? And the government, meaning President and Congress, can do it in 2 ways. They can either spend money or they can give people tax breaks. Now, that's if you're trying to stimulate the economy. Keep in mind that both of these can also work in the opposite direction. Maybe the economy is growing too fast and you've got a ton of inflation. And so the government will actually try and take money out of the economy, which is more than likely going to happen then by increasing taxes, if that's the case. So, or I guess they could slow their own spending down if they want to, but that usually doesn't happen. When we're talking about these multipliers, there's 2 factors we have to pay attention to. Your marginal propensity to consume, which is basically people spending, but let's use consume for clarity's sake, and your marginal propensity to save. If you add up your marginal propensity to consume, so how likely you are to spend a certain amount of every dollar, plus how much you're going to save of every dollar, it equals one singular dollar. All right, which is why with this equation, I'm giving you both ways, but I think just like why not cut out the more complicated equation and just memorize this or have this down on your sheet. But if 1 minus the marginal propensity to consume equals the marginal propensity to save, just use that. So 1 divided the marginal propensity by the marginal propensity to save is your spending multiplier. Your tax multiplier, on the other hand, is weaker than your spending multiplier. And so in this case, we're actually doing the marginal propensity to consume divided by your marginal propensity to save. And this will always be 1 less than the spending multiplier ends up being. So let's actually throw some numbers in here for the sake of more clarity. Let's say that your marginal propensity to consume, which is pretty much always the one that they're going to give you on the exam, is the marginal propensity to consume, is 75 cents of every dollar you earn, you're going to spend. Well, that means your marginal propensity to save, or 1 minus 0.75, is 0.25. And therefore, our spending multiplier in this situation equals 4. If we then go plug these same numbers into our tax multiplier, again, our marginal propensity to consume is 75 cents out of every dollar. Our marginal propensity to consume, again, goes on the bottom here. But if we put it into our more simplified equation, right, it's going to end up being 0.75 divided by 0.25, which is going to equal 3. And so just like I told you, the tax multiplier is always 1 less because it's weaker. All right, so now that we have these numbers, let's take a look at how we can use them. So for the sake of space, I'm going to erase most of this. Okay, and we'll keep those numbers up just so we have them in mind. And so our tax multiplier, get my board stable here, is going to be 3. Now, there's a couple different ways you can see the questions for this worded. All right. You might see a question that says the federal government is going to try and bridge the economic gap by spending $20 billion. And they want to figure out, based on a 0.75 marginal propensity to consume, how much new, I don't want to call it new money, how much additional spending is going to happen because of that. And so if you know that your multiplier is 4, because we've already done the calculations, so 20 billion times 4, okay, is going to equal $80 billion of spending that will happen in total, right? Or additional spending, I should say. It's going to be total 20 plus 80. But additional spending is going to be $80 billion because of that multiplier. But if we were dealing instead of with spending and we were dealing with a tax cut, then that same 20 billion spent tax cut by the government, times our multiplier of 3 is only going to be an additional 60 billion in spending that's happening. All right, so you can clearly see that the tax multiplier is not as strong because you have less money being created in this situation. Let's say, though, rather than working it out from this direction, they tell you what the gap is. And so if they tell you that the gap that needs to be filled is 100 billion, all right, that's the recessionary gap. What you would instead do to calculate how much spending needs to happen by the government is you would take the gap, divide it by the multiplier, and you would determine that the government needs to spend, in this situation, $25 billion in order to fix that recessionary gap. And again, you can do the same thing then with how much of a tax cut is needed by 100 billion divided by 3, which would equal whatever the heck it ends up being. 3 goes into 100, 33. I don't know. Can I do math? No, I can't do math. And so let's just go ahead and actually get the proper number. Oh, my brain's gotten even worse now that we've been out. All right, I was on the right track. And so 33.3 billion that would need to be tax cuts, okay, in order to get to that 100 billion in spending. So it's really pretty simple as long as you figure out which question they're asking you. Are they asking you how much does the spending turn into, or how much does the government need to spend to get to X amount of dollars?